Picture this, June 21st, 2017. Ethereum is trading at $317. The crypto world is buzzing, optimism is high. Suddenly disaster strikes. On GDAX, Ethereum's price nosedives from over $300 to just 10 cents, in seconds. For a brief, terrifying moment, one of crypto's biggest coins is worth less than a gumball. Traders with stop-loss orders watch in horror as their holdings are sold for pennies. Fortunes vanish instantly. Some step away for coffee, only to return to empty accounts. The price rebounds within minutes, but the damage is done. Assets are gone, sold at the bottom. This became a legendary story in crypto, a brutal lesson in the market's wild unpredictability. The Ethereum flash crash wasn't the first, and it won't be the last. Similar events have hit Bitcoin and other coins across exchanges. These moments reveal the hidden dangers beneath the surface of digital markets. They force us to look past the hype and understand the market's structure. In a world built on code and lightning-fast trades, things can go wrong in an instant. Understanding why is the first step to protecting yourself. The lesson? Crypto can be ruthless, and you need to know how to survive its storms. The Ethereum flash crash is a warning. Be prepared or risk losing everything in seconds. The market can turn on a dime, literally. If you're not careful, you could be the next casualty. So, what exactly causes a flash crash? A flash crash is a sudden, massive price drop followed by an almost instant recovery. It's not a slow decline, it's a lightning strike. 1 minute, prices are stable. The next, the floor vanishes. By the time you react, it's already over. Flash crashes are brutal, short-lived, and often triggered by technical failures, not market sentiment. They expose the fragility of trading systems. Unlike a bear market, a flash crash is a glitch, a crack in the market's plumbing. If you panic and sell, you're locking in the worst possible price. The key is to recognize what's happening and stay calm. Understanding flash crashes is your first line of defense. Imagine the market's order book as a street lined with dominoes. A massive sell order, intentional or accidental, knocks over the first domino. It slams through the highest buy orders, then the next and the next, each at lower prices. The price plummets as the order eats through thin layers of buyers. This is the heart of a flash crash. A chain reaction of selling, each drop triggering more sales. In deep markets, there are enough buyers to cushion the fall. But in thin crypto markets, there are gaps. So the price free falls until buyers finally step in, often at absurdly low prices. The domino effect is swift and unforgiving. A single large order can trigger a cascade, wiping out value in seconds. The thinner the order book, the harder and faster the crash. That's how Ethereum hit 10 cents in a blink. Now add trading bots and human panic to the mix. Most crypto trades are executed by bots, not people. Bots follow rules like stop-loss orders to sell if prices drop. During a flash crash, these stop-losses trigger in waves, accelerating the fall. Thin order books make it worse. Few buyers means prices drop even faster. As bots sell, humans watching the crash panic and hit sell too, adding fuel to the fire. The result? A self-perpetuating cycle of automated and emotional selling. The crash deepens until buyers finally step in at rock-bottom prices. In crypto, thin liquidity and automation can turn a dip into a disaster. The lesson: bots and panic amplify every move. If you're not prepared, you'll get swept away. So how do you protect yourself? You're not helpless. Here's how to build your defense. First, avoid market orders, especially when selling. A market order says, sell at any price, which can be disastrous in a flash crash. Use limit orders instead. Set the minimum price you're willing to accept. If the market tanks, your order won't fill at a terrible price. Be cautious with stop-loss orders. Set them too tight, and you risk getting triggered by a sudden wick, selling at the worst moment. If you use stop-losses, set them wider, below normal volatility, to avoid getting caught in a glitch. Diversify your holdings across multiple reputable exchanges. Flash crashes are often isolated to one exchange. If all your assets are there, you're exposed. Spread your risk. Don't put all your crypto in one basket. Learn the tools, limit orders, wide stop losses, and diversification. Stay informed about exchange liquidity and technical stability. Don't chase every price move. Focus on long-term strategy. The right habits can save your portfolio from disaster. In crypto, preparation is everything. Don't wait for a crash to learn these lessons. Protect yourself before the next storm hits. The real secret? Patience beats panic. In crypto, the calm, informed investor wins, not the fastest finger. Panic selling locks in losses, patience lets you weather the storm. When chaos erupts, step back and assess. Is this a real crisis or a technical glitch? Every flash crash is a lesson in market mechanics and risk. The best investors use these moments to learn, not to flee. Believe in your research and your strategy, not the minute-to-minute swings. Use the right tools, diversify, and stay calm. The market will test you. Be the rock that doesn't move. That's how you survive and thrive in crypto.